The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stagflation scenario the Fed was trying to avoid. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the United States. Let's kind of check on these markets. We started the day in the green, but you wouldn't believe it when you look at the numbers right now. The S&P 500 down more than 0.4%, even more so with the tech-heavy NASDAQ 100 down 0.6, almost 0.7%, just off of session lows. Philadelphia Semiconductor Index down even more, 1.1%, NVIDIA being a big drag, and the two-year yield now at about 3.71. So a little bit of movement there, Romaine. It's been a very interesting day in the bond market, and we'll talk more about it.
Yeah, interesting across all asset classes, if you will. We came into today, and it looked like we were going to get a lift from some of those positive earnings, but the negative data showing the U.S. services sectors stagnating. That is the big driver in the market today with the official ISM services number, 50.1. Remember, 50. That's the line in the sand between expansion and contraction. And July's reading, now the fourth in the past 5 months where the index has tiptoed that line.
On Morgan Stanley's economic forecast, the next couple of months are going to see inflation tick up and growth tick down. Growth continue to decelerate. And, we think that puts the Fed in a difficult position.
And that difficult position is evident underneath that headline ISM number, a cavalcade of even dour data points, including employment numbers that are at the lowest since the pandemic, prices paid at the highest since 2022, and an order backlog that shrank for a fifth straight month. And altogether, it encapsulates the stagflation outcome that economists have been warning about amid this tariff policy rollout. In fact, the commentary in that report, it references tariffs and uncertainty a multitude of time, with respondents noting higher short-term costs derailing long-term projects. And that sentiment echoed in the earnings report that we've been getting, including this morning. Beer maker Molson Coors cutting guidance due to aluminum tariffs. Shaving company Edgewell revising its forecast for the third time this year amid FX vol. Decking company Trex raising prices in response to tariff costs. And Caterpillar flagging an incremental hit of as much as $1.5 billion, Sonali.
Really interesting in the earnings world, but I also want to go back to the ISM data that Romaine was just talking about and dive one layer deeper, because the prices paid versus the services employment index here, you can see over here they're going in the opposite direction, and this creates a problem for the Federal Reserve. Neil Dutta of Renaissance Macro says that this shows what the Fed's quandary is, that it's hard to see how price pressures will stick if employment, this yellow line, is cooling. And it helps build a case, according to Dutta, for an insurance cut to rates by the Fed, but it makes it difficult for the Fed to move aggressively, he says, Romaine.
All right, as we kick you off to the close, let's bring Kevin Nicholson into the conversation, global fixed income CIO and partner at Riverfront Investment Group. Kevin, great to see you.
Thanks for having me, Romaine.
We are in kind of strange times, right? We come into today, stocks more or less at record highs. An economy, at least prior to today, had shown some cracks, but still seemed relatively stable. And then we get this services report this morning, which seems to sort of feed into a lot of the fears people have had over the last few months.
Yeah, for sure. I mean, everyone has been thinking that, inflation was going to kick in at some point. And we're now starting to see that. You just pointed out the prices paid. I think that we're probably going to see a Fed that is in a quandary. They are, they're in a vice grip right now, because if you think about where core CPI is, core PCE, core PCE is running at 2.8%. And the only way I think that they're going to cut rates is if they get core PCE headed towards 2.5, not higher. And also, when you think about, the labor force, the 3-month moving average last year at this time was at 82,000 jobs that we were creating going into the September meeting. This time around, we're going to have to put up 159,000 jobs in August in order to get that 82. So, that would argue, if you look through that lens, it would argue for a rate cut. But,
But there is a big question right now about stimulus in general. In the broadest sense of that word, whether it comes from the Fed, whether it comes from the White House or something in between. It seems like we've gotten to this point through these first 6-7 months of the year where we've kind of escaped the pain and the impact, at least in some real amount. But what's to save us from that going forward? Because 25, 50 basis point rate cut isn't going to do it alone.
No, it's not going to do it.
Yeah.
But I think that this Fed has that wait and see approach, and I think that they're going to want to let some of the steam out of the pot, so to speak, just so that they can have a little bit of breathing room. And I think that the calls have been fast and furious for them to cut rates. But let's face it, even if they cut rates, is it really going to get the economy going the way that they're looking for? Because I think a lot has been talked about housing, housing picking up. Well, if we cut rates on the front end, that doesn't mean that we're going to get the housing market going, because they go off of 10-year Treasury rates for all intensive purposes, unless you're going to go into an adjustable rate mortgage. And who wants to do that?
You're talking to the woman who just inked a 6% mortgage and is regretting it. So we'll talk about that more in a moment here, but I do want to talk about the short end of the curve, because the 2-year yield has been really interesting today. You saw the yield higher this morning, then dip lower when you saw the data, and it's higher once again by about 4 basis points. And you would think, if you looked at Fed pricing right now, Fed futures, that you would have a higher chance of a September rate cut. In fact, you went from 97% yesterday to less than 94% today. So what does this say about the market and the fear around inflation relative to employment?
I think the first thing is that last Friday's non-farm payroll just spooked the markets, and the market had an overreaction. I think that the markets moved too fast and too far in a short period of time. And so that's number one. And so I think that that's why you're starting to see yields kind of creep back up, because people, we're now at a point where you look at the front end of the yield curve, even out to a 7-year, you're under 4%. For me, as a fixed income portfolio manager, I'm not buying with yields lower than 4%. Wow. It just doesn't entice me. I'm not getting paid for that, taking on that risk.
Yeah, you need the juicy yields here, and maybe you can get it longer on the curve, but then you take on the duration risk, right? And my question about the 10-year is, how sensitive is it to moves in short-term rates? If the Fed were to cut, do you expect a meaningfully lower 10-year?
I mean, going back in history, you see the 10-year will go down about 20, 30 basis points as it leads up to a cut after a long pause. But I don't think that it's going to be meaningful. I think that even if we get a cut, I think the 10-year goes to 4%.
I am curious, though. I mean, you say you're not enticed by anything under 4, that's not over 4. But it gets to this idea. Are you tactically making moves right now in the fixed income space, or are you on the sidelines? I don't know if that's too much of a broad generalization, but where are you right now? Well,
considering that the portfolios that I run are balanced portfolios, I'm allocating to equities and fixed income. So right now, we're underweight fixed income.
Underweight?
Yeah, because we are tilted towards finance and mega cap tech. And it's logical because they put up great earnings. This earnings season, they were the leaders in earnings growth, and that's where we've been focused. Now, in the fixed income market, we've stayed at the front end of the curve, and mostly in credit. But now credit is so tight, we don't want to be there anymore, and we didn't want to take on the interest rate duration risk because we thought that inflation was going to sneak up, and you're going to see the back end of the curve go higher. And you can still have that happen with the Fed cutting rates and the back end going higher, especially with the asymmetric trade deals that we've had over the last few weeks. You could see, these countries back off from their treasury holdings to be able to fund all of the agreements that they have taken on and those commitments.
All right, Kevin, really intriguing. Got to get you back, and always great to have you in person here. Kevin Nicholson, Global Fixed Income CIO, a partner over at Riverfront Investment Group, kicking us off to the close. His take there on what's been going on in the fixed income space, but you heard him mention mega cap tech, and a big reason for that are earnings. A conversation up ahead with Holly MacDonald to get her take over at Bessemer Trust on where the earnings season is, and more importantly, whether valuations make the stock market a buy.
Plus, with tariffs being a major factor this earnings season, we're going to talk about what could come next and if we're already seeing major reshoring efforts in the U.S. with Kate Kalutkiewicz, trade practice lead at McLarty Associates and Didi Caldwell, president and CEO of Global Location Strategies.
And as we talk tariffs, we are still going to talk earnings and maybe some of the companies that are a little immune to some of those tariff pressures. AMD reports after the bell tonight, a breakdown of what to expect with Matt Bryson. Stick with us. This is The Close on Bloomberg.
Earnings have been coming in better than expected, with tech and communications leading the way. The S&P's growth rate nearing 10% for the second quarter, with expectations rising in tandem. But could all the strength and optimism signal that this is as good as it gets? Let's ask Holly MacDonald. She is Chief Operating Officer and incoming CEO at Bessemer Trust. And that revisions chart that we were just showing investors was pretty stunning, but we have to remember that they fell for a reason. My question about this is, do you still think that there's tariff uncertainty that's not really baked in right now?
I'd say we're through the worst of the uncertainty. Some of the more extreme tail risks, I think, are much less likely now. We're, of course, not out of the woods, but I'd say certainly versus late spring, the shorter term volatility around the policy side should be a bit less.
Do you think that there are real winners and losers that will carry on the story throughout the rest of the year? The ones that have been winning now, you can see the consolidation of the market becoming more and more stark. How do you feel about that? What does it mean about the ones that have been left behind?
Yeah, Sonali, it's really been a story of active investment management. I think here investors are not just playing the AI theme broadly, but it's really what companies have the right strategy and which companies are actually able to execute upon it. I think that's been much more important for market returns rather than some of the broad policy uncertainty as we're now getting into the third quarter here.
How much opportunity are you finding in that space? We were talking on this program last week when the Figma IPO came. There's a lot of anticipation for it, not only because it's a good company, but also there's been a little bit of a dearth of companies of that quality coming to market with an AI story, with a tech story, with a growth story, for that matter. Remember growth stocks? So I do, but I do kind of wonder if we're going to get more of that. So that if you are looking to the AI trade, you don't have to look to NVIDIA or have to look to Microsoft, for example.
Yeah, we see opportunities across the cap stack. I think what's unique about this time period is that it really is the largest companies that are actually growing the fastest. We haven't seen that if you go back decades in market history. That makes it challenging to look at longer term valuations and have a rational argument about where we are versus history, for example. But I think playing it actively company by company really is the way to go.
What about some of the older tech too? I mean, you mentioned kind of these big companies growing at big growth rates. I mean, you think about the success Oracle has had, the stock has had this year, an old tech economy stock that is now a new tech economy stock. And you have a few other names in that space too that were kind of also rans to a certain extent that have found, okay, well, this legacy business actually has real value in this newfangled AI space.
Yeah, I think even earlier this year, some were categorizing Alphabet as being almost older tech and maybe being left behind in the AI story. We were happy to see, even in their earnings, a really strong story around their ability to execute upon their AI strategy. We're seeing that in many elements of their business. That's a name that we'd been adding to throughout the year as it was underperforming, with the idea that they would play some catch up, and we are seeing that coming through.
Maybe I'm too early to this, but I want to pull up the Magnificent 7 index year to date and how things have been performing, and ask the question, do you think that the Mag 7 needs a rethink? Is it time to change the composition of the big, you remember FANG, right?
I remember FANG, and we don't mention FANG anymore.
Right, and Netflix is soaring.
I'm sorry, are you putting a nail in the Mag 7 coffin right now?
Is it too early to do it?
That's a big call. We have not been viewing it as a block for some time and really looking company by company. For example, we're underweight Apple, we don't own Tesla, we're market weight Amazon, and kind of overweight the rest of the big names. And we are seeing that play through this year more so than the past 2 years.
I actually want to build on that because, I mean, underlying her question is a good point about this idea that for so many years we had this bull market where you can just buy the market in aggregate, sit back, kick your feet up, and you would get a pretty healthy return. And anybody who's looked at their portfolio, anyone who's exposed to broad indexes knows that you haven't made a whole lot of money if you were just riding the broad indexes. But if you were picking individual stocks, that idiosyncratic nature of it all, you made a lot more money.
Yeah. Oh, absolutely.
Yeah. So when you sort of start to think about what we look like on the opposite end of this, assuming we come out through this tariff stuff and all the uncertainty with it, presumably there's a light at the end of this tunnel. Does it revert back to where we were, or is this kind of the new normal?
Well, I think as you look into 2026, we're actually anticipating that versus this slower patch in growth that we're seeing right now, you can actually see a bit of a boost. Likely we'll have some Fed easing into next year. We certainly have some tax benefits that will be encouraging CapEx spend, R&D, et cetera. So we think you can get to maybe more like a 3% growth rate early next year. Presumably the tariff uncertainty, to your point, Romain, will be behind us. So you could see a broader base, maybe not just sort of AI-driven rally at that point. And that could give a chance for some of the smaller cap names to play some catch up, some mid cap names as well. Maybe it won't be so much the haves and have-nots on the AI story driving the market at that stage.
How much does valuation matter? We have Bloomberg Intelligence saying that bubble warnings are flashing for the technology, media, telecom sector, and that it's really the highest risk. I guess no surprise here since the dot-com bubble. Do you worry about that bubble bursting?
Well, we always worry about a lot of things as a starting point. And I'd say certainly valuation is one of the factors that is not as supportive of a huge rise in equities from here. At the same time, I don't think it's a huge deterrent from moderate gains going forward. As I mentioned, when you have just the largest companies in the world, also the fastest growing companies in the world, the valuation there is really hard to judge as you look a year out. Those earnings are playing a nice catch up with the valuations.
Just real quick, if somebody said, give me something to buy that's not tech, what do you tell them?
Do you count Siemens as not tech?
They're trying to.
I don't know. I don't know if they're listening. They would count themselves as tech.
Certainly the tech story, but there are, to your point, a lot of industrial infrastructure names that are not technically tech that are secondary beneficiaries of that story. So we are playing there as well. Also, Sonali, to your point, valuations are not as high.
Holly MacDonald, Chief Operating Officer over at Bessemer Trust, and in just a few months' time, she'll be taking over as CEO of the firm. Meanwhile, we roll on here on the close and take a look at some of the big movers on the day, including Wayfair. That stock moving here after the online furniture retailer reported better than expected results in the most recent quarter. We're going to talk to an analyst who just upgraded the stock. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start with Block, XYZ, Morgan Stanley, downgrading to equal weight. The price target held at 73. It's a valuation call. The idea that most of the expected growth acceleration for Block's Square and Cash App units that's already been built into the price. The share is down about 1% on the day. Next up, Oracle, Bank of America raising its price target to $295 from $220. The analyst foresees Oracle being a key beneficiary of positive sentiment on the AI cycle, and it cites Microsoft's and Meta's recent CapEx guidance for that call. We should point out Oracle up about 1% on the day and rallied more than 50% now to start the year. Last up, Wayfair, Citi upgrading to buy from neutral, setting the price target at $93. The analyst saying that the tariff impact there has actually been milder than expected, and says that Wayfair has demonstrated that it's very well positioned to capture share amidst market disruption. Those shares down about 1% on the day, but remember they rallied about 13% yesterday on the back of that earnings report. I'm pleased to say that the man behind that last call joins us right now. Ygal Arounian is a U.S. internet analyst over at Citi. And Ygal, when you looked at the earning, when I looked at Wayfair a few months ago, this was kind of like that one stock, that one company that everyone looked at and said, tariffs are just going to decimate this company. But they seem to be navigating it. How so?
Yeah, so look, that was definitely the view. And the thing is, so much has changed since the initial tariff rollouts on Liberation Day, right? And Wayfair does have a competitive advantage. And this is what a big part of why we upgraded here back to buy. We downgraded on the tariff news, and so much has evolved since. When the tariffs are going to be rolled out unilaterally across all countries, its competitive advantage, in our view, was going to go away. What we've seen since is those tariffs have been rolled back, and there's been trade deals negotiated, and the impact has been milder, really across the entire, consumer ecosystem, but particularly within Wayfair's vertical on home furnishings. The reason Wayfair does better in this type of environment, or can handle this environment better, is because it has thousands of vendors and millions of SKUs that come from different vendors all around the world. And because it's a marketplace, doesn't own its own inventory, it can navigate and rank better in search those vendors that are absorbing the costs or aren't passing through the costs.
So that
said, management.
Yeah, sorry about that, Ygal. To that note too about the consumer, it's not everywhere that you're seeing the jump back. And one place that you've noted in your notes in particular was the home ownership market. And if you go to the top selling items on Wayfair, I like to shop, so I like to look at what people are buying. I've got Romain's attention here. You have a lot of really pretty things that you could buy for your home, but they're like $50 here, $40 there. Every so often you see an Astro gallery of gems for $10,000, almost $11,000. But in broad strokes here, you're looking at generally affordable home goods. How exactly is Wayfair impacted by a homeowner that feels disillusioned right now?
Yeah, so that's a great question. So that's sort of where I was going to go. And what management talked about on their earnings call yesterday is they actually haven't seen much of an uptick, if any at all, in the items that they're selling in terms of pass-through of tariff prices. So we're just really not seeing that much of that. Even in their competitive environment, they're not seeing that much. That said, Wayfair is certainly known for value, and that's what the brand has built, and that's the advantage of having all these different SKUs from different vendors. I think Wayfair does better in a value-oriented environment where shoppers are looking for value. They can leverage their data, their millions of customers and vendors, and they've done a good job being promotional in this type of environment. It's really helped them take share really over the past couple of years and throughout its history.
So what do you think about the downside potential here as well? Because even though they fared well through these tariffs, there are a lot of investors out here that worry that maybe the worst is not over. Maybe that 15% that was expected of the tariff rate becomes 18%. Are they still immune to any of the price pressures?
Great question. We talked about this in our upgrade note as well. I mean, if under a mild tariff scenario, likely the vendors are able to absorb most of that. And they've talked about other areas where there's been savings, like for example, in the shipping channels and logistics. Some of those costs have come down, been able to offset. Where we see the risk and where we'd be wrong is if we just haven't seen the impact big enough yet, right? There's been a pull forward of inventory as vendors have tried to get ahead of tariffs. So maybe you are going to get a bigger pricing impact later into this year, into next year. And then, as the trends have gotten better, part of why the stock is up so much is because you had a really good number of top line revenue, up mid-single digits, where we've been kind of declining and flat over the past couple of years. And maybe we're seeing a pull forward. Now, we haven't heard that. Management said they're not seeing a pull forward. We haven't seen it across the rest of our e-commerce coverage. But if that's a blind spot where consumers have spent up, that could be a risk in the back half too.
Ygal, Arounian, U.S. Internet Analyst at Citigroup. Really interesting moment, Internet and commerce colliding. You have Wayfair up more than 62% this year. But coming up next, we're going to go back to the trade story. We're going to speak to Kate Kalutkiewicz. She is trade practice lead at McLarty Associates Didi Caldwell of Global Location Strategies. Stick with us. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Sonali Basak. You had a very tough morning here because you did see the trade picture turn around the market, but really the data as it pertains to tariffs, which leads us to the president of Switzerland heading to D.C. to make a last-ditch effort to lower the 39% tariff rate imposed by President Trump. This is as the world is facing some of the steepest tariffs by the U.S. since the 1930s. And yet the anticipated retaliation from other countries to raise U.S. tariffs has not materialized, leaving many wondering why not. And here to discuss, Kate Kalutkiewicz. She's trade practice lead at McLarty Associates and former Trump White House trade official. And the question is, what comes next? How should investors be mapping out the roadmap? Because you still have to figure out where the ultimate trade tariff rate ends, as well as how retaliatory tariffs might come into play here.
Yeah, it's extremely challenging to predict. And so I'm not going to predict where we're going, but I will tell you this remains extremely dynamic and extremely turbulent because at the end of the day, what we know about President Trump more than anything is that he always wants to negotiate. He always thinks he can get a better deal. So, although the dust has settled for several trading partners, which have, negotiated the outlines of some broad agreements and have some calm for the moment, the president is going to continue to try to change this landscape in a way that makes sense for U.S. manufacturing and more investment into the U.S. market. Those are his key goals. He will keep working on that. We've got more than 3/4 of his presidency to go. So I think we're going to have to continue to be prepared.
Be prepared, but how are we measuring actually the progress on this, Kate? There's been a lot of discussions about these what are effectively handshake agreements at this point.
Yep.
And when we talk about those investments, these commitments that these countries are promising, I guess who's really going to keep track of whether those countries actually follow through?
This is really the important question, because I think, these are not legal documents yet. They're not legal texts with enforcement mechanisms. And so I think everyone is going to be very careful about ensuring that President Trump remains happy. And the happy President Trump of today is not necessarily the happy President Trump of tomorrow. So, I think his surrogates, the Commerce Secretary, the Treasury Secretary, the U.S. Trade Representative, they are going to continually be briefing him on whether trading partners are fulfilling these commitments. And so I think there is sustainable leverage there to ensure that the commitments made by trading partners are actually followed through on. But you can bet that the White House will be watching.
What about some of the more sensitive trading partners like India, for example? I think it was surprising to a lot of people to see two countries that have been growing closer together face this hiccup in trade talks. How do you think that could start to impact the relationship between the two countries that find each other strategically important?
Yeah, no, India is really one of the most challenging trading partners with which the United States is negotiating, not least of all because of the strategic partnership. It does complicate how far President Trump is willing to push President Modi. The two have a very positive relationship, but on trade in particular, President Trump is not wrong when he says that India has some of the most pernicious, the most difficult trade barriers. It has been an incredibly difficult market for the United States to crack. And I think President Trump has been very clear about what he's trying to achieve here. He just does have to manage it in a very careful way because of the strategic partnership. But remember, on Liberation Day, back in April, he said it was going to be harder for our friends in some cases. And I think this is evidence of that. Well,
certainly so. It's also harder, though, on U.S. companies. Just this morning, Kate, we heard from Caterpillar. They're finally quantifying the effects of tariffs, $1.5 billion roughly on the top end. But then there was interesting report just a few minutes ago that the governor of Michigan, Gretchen Whitmer, was at the White House, or at least spoke with President Trump, I should say, about the impact on the automotive industry. And we heard from Jim Farley, the CEO of Ford, and a few other automotive executives really not mincing any words about it. And there's a big question right now, not so much just about the tariffs they're paying, but about the idea that they cannot move manufacturing back to the U.S. in an expedited way that would sort of free them of those tariffs. These are projects that would take years to actually get up and running.
Yeah, that's true. And I think that the Trump administration is realizing that for many of the strategic sectors, including automotives, this is not a day-to-day discussion. We have to secure new investment sites. We need to hire workers and train them, and really building out these facilities takes years. I think the automakers in particular as well have been a bit confounded by the goals here. On one hand, very protective tariffs of 25% in the auto sector, but our trading partners have been able to bring those rates down. Yeah. The Japanese, the Europeans, I think the Koreans as well, though we don't have those details yet. What this means for the competitiveness of the American automakers, I think, remains to be seen. And I think this has been the challenge in having so many different actions, so many different goals, so many different negotiations, oftentimes undermining each other. So there is still a lot of work to do.
All right, Kate, got to leave it there. Kate Kalutkiewicz, trade practice lead over at McLarty Associates and former trade negotiator there during the Trump administration. We do want to continue on this topic right now and bring into the conversation Didi Caldwell. She is the president and CEO of Global Location Strategies, a company that helps foreign and domestic companies with site selection. And Didi, I do want to start with this reshoring argument, if you will, and the idea of which sectors, what industries maybe have more flexibility, a more cost-effective flexibility, I should say, to actually bring their goods, their manufacturing, their processes fully back here into the United States.
And I think that's a great question, but I think it also depends on the time frame that you're looking at. Because if you're looking at the near term, you're thinking more about light industrial operations, which are easily able to pick up their capital, their equipment. They don't have a lot of sunk cost in other countries and move it back to the US or to a location that has a more favorable trade policy with the US. But if you're talking about some of the industries which could probably be best advantaged over the long term, those are going to take, years, maybe even a decade for those to relocate back to the US. So for example, we produce less than 10% of the primary aluminum that we consume in the United States. We import a lot of that from Canada. The US is very competitive because of the shale revolution and the low cost of energy that we have here. But these are investments that take billions of dollars and several years just to site, to permit, to build, and to commission. So it's not like we can turn on a dime for those types of industries that might really be advantaged by being here. In the meantime, all of the other companies that import aluminum are paying a 50% tariff.
I'm glad you brought up aluminum because I remember, and this has been rolled back to a large degree, but I remember when Trump placed the tariffs on copper, for example, and the limitations there are to mining copper in the United States, and the reliance, therefore, that many types of goods would have on what is a natural resource. So what are those other natural resources where decoupling from trade will be very difficult?
Well, there's been a lot of talk about rare earth minerals. So China almost completely dominates the mining and the processing of rare earth minerals, as well as the magnets that are made from them. And this isn't the first time that China has flexed its muscle in this area. And what happened at that time is that the Japanese decided, well, we need to have an industrial policy. So they went to Australia and Malaysia and Vietnam to ask them to help them reduce their reliance on China for these rare earth minerals. The United States did not do that at that time. So we're still in a situation where we're very much coupled with China in order to be able to meet that need. And I would put that in a lot of the critical minerals like lithium, copper, nickel, platinum. There's a whole list of things that we do not make nearly enough here in the United States to supply the demand that we have.
For companies that are trying to sort of adjust to this current environment we're in, how much faith can you put into the idea that the policies of today are still going to be the policies a year from now, or more importantly, 3.5, 4 years from now?
Very little. I think that we're seeing policies change almost on a daily basis. I've lost count how many changes there have been to the tariff announcements that have been made since April. But, we do know that there's a midterm election coming up in 2026. There's going to be a presidential election, and presumably Trump will not be on the ticket then. And it's very difficult to know. A lot of these tariffs have been put in place by executive action. Some of it is being litigated in the courts right now to whether or not these actually constitute a national emergency, the trade imbalance. But certainly that could happen earlier than the next election. And there's no guarantee that the next president and his or her administration will have the same viewpoint on tariffs.
Didi Caldwell, President and CEO of Global Location Strategies. We thank you so much for joining us today. And we'll be right back with more markets ahead. Stick with us. This is The Close on Bloomberg.
Time now for our stock of the hour. Yum Brands shares down 5%, worst day since April 4th. This on the back of earnings that showed 2% comp sales growth below estimates. Earnings that showed gross margin growth of 16.3% below estimates, and EPS of $1.44 below estimates. Michael Halen joins us right now, senior restaurant analyst over at Bloomberg Intelligence. KFC, Pizza Hut, all our favorites. Michael, what's going on over there?
I'd say the biggest concern today is around Taco Bell. And although they outperformed the quick service industry significantly by 400 basis points, their outperformance shrunk. Their 2-year stacked same-store sales kind of decelerated by a couple hundred basis points. And that, I think, caused a little bit of concern about from the investor community, right? So a big plan of theirs this year was to double the number of limited time offers and promotions they had throughout the year. And that's tough to pull off, right? And if they can't pull it off successfully, there's questions about whether or not 2026 will see another year of mid-single-digit same-store sales growth.
So what's the problem? To Romaine's point, these are your favorites. So why aren't promotions working?
Well, I would say promotions are working at Taco Bell. It's just a law of larger numbers. As the average unit volumes continue to grow, it's harder to generate mid-single-digit growth. It's just kind of math. I'd say another concern could be just the loss of talent. Yum Brands has lost a ton of very good talent over the years. We're seeing former Taco Bell and Yum Brands executives running Starbucks, Cracker Barrel, El Pollo Loco, Shake Shack, right? And so there could be a question about whether or not they have the talent, to continue the strong growth that Taco Bell has seen for quite some time.
Michael, we thank you so much for keeping an eye on all of it for us. That is Michael Halen, Senior Restaurant Analyst at Bloomberg Intelligence. And so interesting to see that it's not all consumer companies behaving the same.
Yeah, this is really an idiosyncratic market. You've probably never had Taco Bell. You look like you would never touch that. So, but there was a brief moment in my 20s where I basically lived off chalupas and God knows what else I was putting in my body.
Unreal.
But,
I'm a Pizza Hut kind of girl. What can I do? Anyways, coming up, we're going to take you to the closing bell. We're going to bring in Melissa Brown, Head of Investment Decision Research at SimCorp. Stick with us. This is The Close on Bloomberg.
Right now, we're underweight fixed income.
Underweight?
Yeah, because we are tilted towards finance and mega cap tech. And it's logical because they put up great earnings. This earnings season, they were the leaders in earnings growth. And that's where we've been focused.
Kevin Nicholson over at Riverfront Investment kicking us off to the close 50 minutes ago. And he's right. They are showing earnings out of those those mega cap tech names, but there's a high price attached to those names as well, and you kind of have to find the balance.
The valuations can be hard for some people to justify, especially when you have economic data that is turning the market around. That is certainly what happened today, and we're seeing a little bit more of it every data point we get.
Yeah, you take a look at the S&P 500 right now, Shonali, holding that 6,300 line, a key line in the sand for a lot of folks.
I'm sure a lot of people are missing 6,400 remain.
Absolutely. NASDAQ down 0.6%, a little bit more softness there when you get into the tech space with the Philadelphia Semiconductor Index. And I do want to point out there are a few bright spots, believe it or not, and that's actually in the mid caps and small caps and the transports for some reason. So it's kind of interesting that you would see that negative ISM services number or that dour ISM services number and see people flocking to maybe some of the more goods producing companies.
The things I always want to forget about.
Yeah.
However, you did see a drop in yields a little earlier relative to where we were, but they're still higher, and it's interesting to see those companies do better, even with that short-term rate a little higher.
It'll be interesting to see the price action as we get closer to the closing bells. Those bells just a little more than 8 minutes away. Joining us here in Studio 2 is Melissa Brown, Head of Investment Decision Research at SimCorp. And Melissa, I do want to start off with valuations, and I'm going to just use Palantir as an example because they reported earnings yesterday, and it's actually one of the best performing stocks today. It's actually the best performing stock of the year in the S&P 500. It's also a stock that trades at something like 300 times forward earnings and something like 80 times forward sales, which I think by any measure for a company of that size is, I won't say unprecedented, but certainly rare.
Yes.
And it gets to this idea of what are people buying? Because I always thought the market was supposed to be this forward pricing mechanism. So are investors looking at this and saying this is a company that can literally grow 300 times their current earnings?
I mean, that's certainly the implication in those kinds of valuations, that the growth has to be there to justify it. I mean, maybe the growth will be there, but I think, everything has to go exactly right.
There's a big question, though, about what valuation is these days, right? There are some people that will talk about the traditional metrics, PE, price to book, things like, and they'll say, oh, that's antiquated. We're different economy, and the companies make different things, and the way they expense them is different, and so we should be looking at, whatever new esoteric measures they come up with. How do you feel about that?
Maybe I'm old school.
It was a loaded question, but thank you for answering.
Having been around for a long time, and over the years, during the internet bubble, you heard similar arguments. You've got to value price to, I don't know, revenue subscribers or whatever it was. But it's always ultimately come down to valuation. That the traditional valuation, price to earnings, price to book, price to sales. And there's no reason to think that's going to be any different. If you look at something like the Shiller PE, the very long-term PE, I mean, that data goes back to the 1800s, and it's, you can still see the impact of that PE. PE gets very high, markets tend to go down.
Big tech is where you see a lot of those very, very lofty PEs, if you will. And one question we've been asking on this show is, well, wait a minute, the Mag 7 is not performing as a group, right? Some are doing better than others. Does it mean you have to rethink what would go in the Mag 7? Do you have to kind of create a new barometer of chasing the high flyers if that's what you want to do?
Well, and maybe limiting it to 7 stocks or, you know, calling them all magnificent or whatever is not really the right way to think about it. And yeah, probably there are, you know, some stocks that shouldn't be considered part of this grouping, and other stocks that maybe should. But 3 months from now, that could be completely different. I think there's high flyers and there's everything else these days, and it may be 7, it may be 10, it may be 3, but it's not 100.
You know, it's interesting. Speaking of high flyers, we're talking about Palantir a lot. It's up almost 130% this year. GE Vernova up another 98%. Supermicro up 88%. When you have a market that's trading like that, to your point on high flyers, it's not those classical names. What do you do? Do you have conviction to actually go short at any point some of these names that seem to be so loved?
That does seem to be very difficult, I think, to make that decision to short those kinds of names. And also, you know, we've seen this year, even before this year, this, you know, kind of buy on the dips. So I would even worry if some of those stocks were to start to fall, that being short might not be the best move because people are going to come in and buy on the dips.
The buy the dip mentality, though, do you have any evidence that we're actually seeing that more from the institutions? I mean, I know there's been a lot of talk about how retail traders are driving this more, but is there any evidence that the institutions are also following?
I have not seen any evidence. I mean, most institutions farm out their money, and their managers really can't do that. And so I think it really has been more of a retail-driven phenomenon.
I do have to get your thoughts, though, about the ISM data that we got this morning, and really just kind of the confluence of data that we've gotten over the last few weeks that seem to be ratifying some of the fears about this tariff policy rollout. And I do wonder if you think that's going to intensify, meaning the negative data and consequentially some sort of negative hit to the bottom line for corporate America.
I think that is going to happen. I think, you know, it's been slowly dripping out. Most of the news that's come out has not been very good over the past couple of weeks, whether it's higher inflation or the ISM data or whatever. And I think at some point there's probably going to be a tipping point. We haven't seen it in second quarter earnings, and you know it's always easy to push it out and say we'll see it in third quarter earnings. We may or may not, but I think there is this potential of a tipping point, that all of that data that's not pointing to a strong economy is going to eventually show up in corporate profits.
All right, Melissa, always great to talk to you. Melissa Brown is head of investment decision research over at SimCorp, counting us down to those closing bells. Those bells now just about 3 minutes away, Sonali. And we should just point out for our viewers, when we were talking about earnings, we get a slew of earnings after the bell. It continues here. The biggest, of course, is going to be AMD, the big chip maker, but we also get Rivian, the EV maker, Amgen, drug maker. So a nice cross-section of our economy. And
it's still early in the week. We have a lot more earnings that will represent the real economy. I do want to point out something that was written about today that speaks to what you were talking about. Citadel Securities is actually looking at big institutional investors, systematic funds in particular, that are going to run out of dry powder, they believe, by the end of August. Let's see if the dip buyers come in then. Is the major question, I think, remaining.
A good point here, too. And we should also point out a volume starts to get a little bit light over the next couple of weeks, given, you know, everybody's away for the summer. Why are we still here?
I don't know. Time to go on vacation? Still earnings season.
All right. Well, we're not going away just yet here. We got a lot to cover, including a full breakdown of all of today's market action and a full rollout of all of those earnings. That starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Sonali Basak. taking you through to that closing bell. It's a global simulcast. It started. Carol Massar in the radio booth. Matt Miller by our side. Tim Stenovic has the day off. Welcome to our audiences across our Bloomberg platforms, including our partnership with YouTube. A bit of a pullback, Carol Massar, from that rebound rally we saw yesterday, and a lot of that seems to have to do with the economic data.
Listen, Matt keeps talking about it. I mean, little moves here in the overall marketplace, but you dig a little bit deeper and you go into something like the S&P 500. You've got some big movers. Axon, we talked to the CEO. That stock's up 16%. Palantir, also up about 8%. So we do have some individual moves big time within the in the market.
Yeah, for sure. To me, the most interesting thing today is still what I think Scarlett mentioned yesterday, that the 10-year yield dropped down, and I've been talking about this with Shanali all day as well. The 10-year yield dropped, and really the whole curve fell on Friday. It was pretty amazing to see, and now we're at 420 in a world where yields should be like 450, according to Bloomberg Economics. And yet, even with the recovery in equities yesterday, you haven't seen those yields budge. I just think it's really fascinating.
Just loves 420.
Yeah, it was interesting too because we were talking with Kevin over at Riverfront Investments, and he was kind of talking about this idea. I mean, he's a fixed income investor, the CIO of fixed income over there. They're saying he doesn't really find anything attractive right now in the fixed income space. He's underweight and basically saying that if it's under 4%, he's not getting out of bed for it.
I do think it's interesting, though, that you did see even equities turn lower after that ISM data came out this morning, which is telling you that the macro is still driving this market. So this time to the downside.
And we are going to get the micro here with several earnings coming after the bell with AMD, Super Micro, Amgen, Rivian, Toast, Match, as well as Mosaic and Skyworks. Let's walk you through the closing bells real quickly here. A Dow Jones Industrial Average down more than 60 points or 0.1%. The S&P closes below that 6,300 level by just a fraction of a point, down 0.5%. The NASDAQ down 0.7%. And believe it or not here, this is actually the relative bright spot on the day. Your Russell 2000 higher on the day by 0.6%.
All right, you teased Amgen coming out with earnings, and indeed they have crossed the Bloomberg terminal. Let's get to it. The company boosting its 2025 guidance after quarterly results beat Wall Street estimates on the back of strong sales from older medicine. The company now expects full-year revenue of as much as $36 billion, lifted the high end of its adjusted profit guidance by 10 cents a share, and the company reporting strong sales across its portfolio. Second quarter revenue, $9.18 billion. That beat Wall Street expectations, and that's driven by sales of medicines such as Repatha, Evenity, I think it is, and Otezla. So we are seeing...
Love pharma names.
I know. Why do they do that to us?
Whose job is that?
Stock is unchanged here in the aftermarket. It's up 15%, though, year to date.
All right, let's get some other earnings. Skyworks crossing the wire, of course, primarily a supplier for iPhones and smartphones, I should say, overall. The company says that in the most recent quarter, it had revenue of $965 million. That's a beat. The street was looking for roughly $639. Adjusted EPS also beating estimates. And here's your guidance. The company says that for the fourth quarter, adjusted EPS will be $1.40 a share. The street on average was only looking for 99 cents a share. So that would be a huge beat, and you see that reflected in the knee-jerk reaction there in the bottom corner of your screen, up 7% in the after-hours trade.
Pretty nice stuff. You see similarly for Amgen, they actually boosted their full-year revenue forecast to $36 billion. They initially saw $34.3 to $35.7 billion. The low end of the new range is $35 billion. So that consistency here with those upward revisions certainly coming out of corporate America in the face of tariffs. I know Matt has been talking all morning about the threat of higher tariffs on the pharma industry, in particular from the president.
Yeah, I can't forget about the Sunday press conference in which President Trump reiterated he wants to cut drug costs by 1,500%, which obviously it's not possible, but especially if you're going to raise tariffs to 250%, which is what he told CNBC this morning. So Amgen, is a massive company, $160 billion market cap. Skyworks, much smaller. It's only a $10 billion company, and it's getting smaller, right? Because Skyworks has shrunk. It's lost about a quarter of its value so far this year to date.
I'm also taking a look here at Trivago as well to see how more of the consumer is doing here. And you're looking at revenue also beating estimates once again. So that's 3 for 3, guys. Yet you are not seeing as warm of a reaction here in the stock price, still down more than 3%. We'll parse through to let you know what the big deal is there.
I'm looking at Rivian right now, out with a second quarter loss per share of 97 cents. I was going to say only 97 cents because they lost almost $1.50 a share last year, 146 to be exact. Second quarter revenue, $1.3 billion, and that actually beats the estimate of $1.28 billion. They delivered, get this, in the quarter. This is for a 3-month period. 10,661 vehicles. That's lower than they were expected to deliver with the estimate. The shares right now are down about 6%. This is a company that just started producing cars at exactly the wrong time. Remember, right in the middle of the pandemic, they couldn't get any chips, and now they've never been able to lift production more than like 50,000 a year.
Well, look at that. Well, look at that 2Q production number. That was a big miss there. Less than 6,000 vehicles, Matt, and the street was looking for about 7,400. So a huge sort of downshift, if you will, on the production side.
Yeah, it's pretty unbelievable. They expect to deliver only 40,000 vehicles this year, or 40 to 46,000 at the top end. So even fewer than they delivered last year. It's pretty amazing to me because I think they're such attractive vehicles and they're so powerful.
You have one of these too, because you have a big car collection, right? It's like F-150.
I do not have a big car collection, but I love big cars. Yeah. And
Dodge,
what they
Charger.
need to make at Rivian is a smaller, more affordable car, right? Not everybody's going to run out and pay $90,000 for an EV these days.
Is a key one.
Hey,
all these EVs are overpriced.
While you debate this, why don't we take this offline? I'm going to go back to Skyworks because that stock is up about 8% here in the aftermarket. I'm going to go again to the outlook. The company's seeing fourth quarter revenue of $1 billion to $1.03 billion. The street estimate is $883.1 million. And then the company also talked about fourth quarter adjusted EPS of $1.40. The street estimate is 99 cents. So you can understand the stock's been under pressure this year, down about more than 20% year to date, but we're seeing about a 9% bump to the upside here in the aftermarket.
We're also waiting here. We're watching Lucid crossing the wire as well. So speaking of vehicles, you're looking at the adjusted loss per share at 24 cents. The estimate was 22 cents, so at least EPS beating on expectations. They see full year production at 18,000 to 20,000 vehicles. They had initially saw 20,000, so they gave a new lower end of the range. And there you go. There you have it. Lucid down another 5% after
Toast, of course, this is the restaurant payment platform with their earnings, 2Q revenue. Looks like it's coming in at a slight beat, $1.55 billion. The street was looking for $1.52. EBITDA, the bottom line number, $161 million. The street was looking for $139 million. And the company says that hardware and its professional services also looks like a beat as well. No guidance, but you see a modest move higher in the shares.
All right, Supermicro is out, and they post, first off, a disappointing fourth quarter adjusted gross margin, 9.6%. The street was looking for 10%. The EPS for the fourth quarter, adjusted EPS, was also a disappointment at 41 cents versus the estimate of 44 cents. In terms of the outlook, they see net sales of at least $33 billion. That's a little bit better than the street's estimate, but the stock is down 13% in the after hours trade. So everything in the fourth quarter missed estimates, and I guess it doesn't matter if they lift their 2026 sales estimates above what the street expects because investors are so disappointed in this company right now.
All right, got a quick one for you. Supermicro, as Matt mentioned, down about 11%. Klaviyo, let's get to that one, crossing the Bloomberg terminal. Application software company, get to the outlook, sees fiscal year revenue of $1.2 billion to $1.2 billion. So looks like no range there. The previous had been $1.17 billion to $1.18 billion. As for the second quarter, revenue of $293.1 million, that is a beat. The street was looking for $278.7 million. You're seeing that stock up about 7.5% here in the aftermarket, and we have seen this stock under pressure this year, down about 25%, but investors moving into it in the aftermarket.
I want to take a look at Open Door Technologies as well, because you may remember the meme stock frenzy that has hit this stock. It's now down more than 12% after the market because it says third quarter revenue would be $800 million to $875 million. The net loss of $9 million is compared with $13.7 million. But remember, this is a company that had been extraordinarily run up to until this moment. Revenue actually beat estimates here. You're seeing this decline still after market.
We don't just remember Open Door, Shonali. We will be talking to Eric Jackson later this hour. So while you continue there on television, Eric Jackson from EMG Capital is going to talk to us. And he was touting this stock before before the meme craze hit again.
You talked about
Arista Networks also out with its earnings. Those shares moving higher by about 7%. The cloud networking company did beat on both the top and bottom line. $2.2 billion in revenue on the top line, 73 cents in adjusted EPS on the bottom line. And we're going to look at the services revenue as well as some of their costs here. Both of those numbers also appeared to beat estimates.
All right, big drop and more earnings to come. We've got Snap coming our way, AMD still to come, and a few others that should cross the Bloomberg in just a few minutes. So we'll be tracking it down.
Arista Networks is a cloud computing company. Isn't that like Aretha Franklin's label? Whitney Houston?
Guys, we gotta go.
Arista. Okay, we got to wrap. We got to wrap.
Yeah, okay.
That'll do it for our cross-platform. A lot of earnings, still more to come. Radio, TV, YouTube, Bloomberg Originals, we do it all. Of course, Romaine and Shonali continuing there on TV, and Matt and I continuing right here on Bloomberg Business Week Daily.
The Grateful Dead signed to Arista.
Yes, they did.
Our coverage continues here on Bloomberg Television, a deeper dive into all of the earnings that just crossed the wire, and we're still waiting for the biggest one of the night. That is AMD. It's imminent. We'll break it all down for you when we come back. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Yesterday's rebound rally that we saw in stocks was driven by a positive outlook on earnings. That got taken down a notch earlier today after we were reminded about macroeconomic conditions and ISM services number that disappointed a lot of folks, and that led stocks lower on the day, fractionally to be sure, but significant moves with the S&P breaking below that 6,300 level. The VIX rising ever so slightly up to around the 18 level, and weakness once again in the crude oil space. That is the cross-asset macro backdrop, but we go back, of course, to the micro backdrop earnings. They are coming out fast and furious, including just a few minutes ago, we learned from the social media company Snap. That company reporting second quarter results that came in just in line with estimates, $1.34 billion. Daily active users coming in at about 469, pretty much on the nose of what the street was looking for. But EBITDA came in light. And here's your guidance going forward. The company giving revenue guidance for the third quarter of $1.4 to $1.51 billion, the low end of that range in line with the average of street estimates. But the EBITDA forecast, 110 to 135, a pretty wide range with the average of analyst estimates pegged in between at about 116 million. Those shares down 15% in the after hours trade. Match Group also in the social media space, but of course more directly towards dating. Those shares moving higher, up about 10% after the company said second quarter revenue did beat at about $164 million, and the company also beat on the bottom line as well. Now for the third quarter, it's giving guidance on an operating income basis of 330 to 335 million, the top end of that range in line with the average of street estimates. The company also hiring a new CTO and saying that some of the direct revenue that it's getting from Hinge, a key player here in the company's growth story, also coming in above estimates at about $168 million. The shares up by about 9% here in the after hours trade. And that actually brings us to our top story here. And that really is the dissonance that we've been seeing between the economic data and the corporate earnings. We started the day with a reminder that the tariff impact really has just begun. It was ISM data, headline data, that pointed to a slowdown in the services sector, a services sector that accounts for more than 3/4 of U.S. GDP. And that sector is stagnant, no material growth. Yet, it's a data point that also reflected material inflation, with prices paid by companies now the highest since 2022. Now, it's a backward-looking number, to be sure, but so too are corporate earnings. And yet, corporate earnings have been on fire. The S&P 500 for EPS growth, that's tracking at 9.6% for the quarter, more than triple the expectations heading into the earnings season, as more companies are finding more ways to try to mitigate some of these tariffs. This afternoon, we're learning more about those strategies with some of the earnings that we've gotten so far, like out of Amgen, like out of Rivian, Mosaic, Apple supplier Skyworks, and of course, chip maker AMD. We're still awaiting those earnings out of AMD, but they should be hitting the tape any minute now. Our next guest, he has an outperform rating on the stock, saying that the chip maker is, quote, the most likely vendor to represent a meaningful alternative to NVIDIA. Matt Bryson joins us right now, Managing Director of Equity Research at Wedbush Securities. All right, we're waiting those results. When we talk about this being a viable alternative, how do we get there, Matt?
Their structure, if you will, looks the most similar to NVIDIA, right? They're selling a GPU. So it can go to third parties. You don't have to develop your own ASIC. And again, you look at where NVIDIA's data center GPUs came out of, their AI solutions that came out of their gaming product, and AMD was the lone competitor in that gaming space. So revenue-wise, they are the they're a far cry from NVIDIA, but they're also the only company out there with more than $1 billion in revenues with a standalone solution.
All right, we'll hold that thought. The earnings crossing the wire right now. Revenue in the quarter growing 32% to $7.69 billion. That's above street estimates. The street was looking for $7.43 billion. Operating income coming in a little bit light at $897 million. The street was looking for $903 million. Operating margins relatively in line with estimates at about 12%. And it's CapEx spend well above estimates, $282 million. The street was looking for roughly about $177 million. Now, here's your forecast. The company says that for the third quarter, it expects revenue in a range of $8.4 to $9 billion. The street was looking for 8.37. So the bottom end of that range, just a tad above what the street was looking for. The company says that's going to be about plus or minus $300 million. A knee-jerk reaction, a modest gain in the shares, up about 2% here in the after-hours trade. Matt Bryson still with us over at Wedbush. And Matt, I know you haven't had a whole lot of time to parse these numbers. We'll just call them relatively in line with estimates. But I do think it's interesting. They are guiding a little bit higher on the revenue side for the current quarter, but also guiding higher on the CapEx side. And I know $282 million is nowhere near the tens of billions of dollars that we're hearing out of Microsoft and Meta, et cetera. But that's still a good sign, right, that they are investing back into this business, is it not?
It's definitely a good sign. I think part of it has to do with the fact that they just acquired ZT Systems. So they got that added infrastructure. They're doing more around building systems. And that just requires a bit more CapEx than they'd invested previously when they'd really been just working on the chip side of things.
I know we spoke the other day kind of as a preview to AMD and kind of, what we can expect to hear out of Lisa Su and her team and what the sort of the long-term AI strategy looks like. Do you have a sense of what that strategy looks like?
Yeah, I think they're doing the same thing that NVIDIA has done. Look, NVIDIA turned it from a single chip solution or a single server solution into a big cluster, right? So a bunch of servers working in parallel. AMD is moving down the same path, and they start in that direction with the 350, 355, which they're shipping now. And it's really the 400 that everyone's waiting for that is supposed to look like NVIDIA's GB200 solutions.
I mean, this is still a company, though, when we talk about their current product mix, or at least who their current end customers are, it still has a pretty outsized exposure to personal computers. I know it has a huge data center business. I think that's 40+% of their business now. But when you look at the exposure on personal computers and the more consumer-facing side of this business, is that a risk for investors going forward or an opportunity?
I don't think it's a risk for me. So when you think about that business, well, first off, they're doing really well, right? So they're taking share from Intel because in part they're executing, in part Intel has its own struggles. But then the other piece of this is really it all comes down to AI, because that market has gotten so big where you've got NVIDIA doing, if I recollect, it's like $40 billion this year in AI revenue. If you think about AMD getting to, or this quarter, sorry, if you think about AMD getting close to 10% of that, it's such a huge swing for them that at this point, that's what everyone's focused on. And even though AMD's killing it in personal compute, even though they're killing it in compute for servers, it just matters less because those AI numbers are so big.
Is there any tariff or trade policy risk associated with AMD in the same way that we kind of associate with NVIDIA and some of the other chip makers?
There's tariff risk in that AMD, like NVIDIA, they mostly manufacture through TSM, so it's through Taiwan, so you get a big tariff, it's going to hit them. At the same time, I think the bigger risk isn't how much they'd have to pay in tariffs, it's rather, do tariffs end up being destructive to the economy, and particularly the tech economy? And that weighs on everyone.
All right, Matt, we'll let you get back to it. Of course, we're still waiting on that conference call. AMD shares fractionally higher here in the aftermarket trade. Matt Bryson over at Wedbush Securities helping us break down those earnings. When we come back, we're going to break down the earnings out of the EV makers. Rivian, Lucid, just reporting earnings. And a lot of questions here, not just about the health of those companies, but really the EV market overall. Stephanie Valdez, Streaty, over at Cox Automotive. She joins us in just a second here on The Close on Bloomberg. All right, we just got earnings out of the EV sector. Lucid and Rivian hitting the tape just a few minutes ago. Rivian coming in with an adjusted loss per share in the quarter of about 80 cents, wider than expected, and it gave guidance saying that those losses are expected to grow. Lucid also out with its results and forecasting, saying that revenue did grow 29%, but it also did post a loss per share that was wider than what the street was looking for of about 24 cents. Joining us right now to talk a little bit more about what's going on in the EV space is Stephanie Valdez Streaty. She's Director of Industry Insights over at Cox Automotive. And one number, Stephanie, that jumped out at me out of both of these companies, and it's kind of the ties that binds, it's their production numbers, their forecasts. They're basically saying that production was lower than expected in the most recent quarter and is likely going to be even lower for the rest of the year. And it raises the question here as to, is there demand, healthy demand right now in the EV space, or is this something very specific to just these two companies?
Yeah, I think we're at a turning point, right? The training wheels have been taken off with the IRA EV credit elimination. So I think the market's going to have to adjust. I think the next few months, the IRA credit is eliminated September 30th. So we're probably going to see an uptick in EV sales during this time frame and then start to slow down. So I think the manufacturers are looking forward, like how are we going to adjust to that slowing of demand? Because at the end of the day, there's still a price premium. And if you look at both Lucid and Rivian in particular, they have very expensive vehicles. So part of their long-term sustainability is how do they have a vehicle that's going to have mass appeal? How do they become more efficient? And just be able to scale, too, efficiently. I think those are some of the challenges that they have. And they don't have the luxury of the ICE revenue that our domestic legacy brands have. So they have a lot of headwinds coming their way.
Yeah, that's what I'm curious about, too. I mean, affordability has always been a big factor when it comes to EVs. And I know it's a relatively nascent industry, and this is kind of how industries start. You start at the premium price, and at some point you scale up and get down. But we haven't really seen that. I know Tesla has had a little bit of success with one of its models, but a lot of that is through a lot of incentives and lease programs to get that out-the-door price to something manageable. Does Rivian or Lucid, do they have the ability to get creative with financing and leasing and things like that to make it more affordable to the customer?
Yeah, I think looking at Rivian, right, the R2, I think that is going to be so important how they're able to execute and launch that. That's going to be that more affordable, right? It's going to have more appeal. And so I think if you look at the Rivian brand, I don't know if you looked at the consumer report from last year, they had the lowest quality. But still, owners of Rivians love them. So they have really strong brand. So they just need a real affordable EV, and that R2 is it, right? So if they can roll that out, get mass appeal, I think they can, start to become more profitable over time if they are able to stick to that. And in the meantime, right, become more efficient in their manufacturing processes. And luckily, they have the VW partnership, which can help with capital, synergies, supply chain, collaboration. So I think they have potential. It's really how they're going to execute and how do they navigate the next few months, the next 6 months when demand starts to slow down.
Yeah, it's funny you mentioned, I forgot all about the Volkswagen partnership, but it gets to the idea, though, what does Lucid have in all this? I mean, this is a company that kind of deliberately positioned itself in the luxury space, and it's not a stock or really a car that a lot of people talk about when you talk about EVs. You hear a lot about Rivians, obviously Teslas, and of course, some of the vehicles coming out of the traditional manufacturers, but I don't know. I mean, Lucid?
Yeah, Lucid, they have the premium technology, right? They have probably a lot, like if you think about this, the longest range, right? They have it, but they haven't been able to scale. And to your point, they have the Gravity, the SUV now, which is a very competitive, very popular segment. So I'm glad they have that, but the price point is still very high. So once again, like Rivian, they need a more affordable, scalable product that's going to help them really become sustainable. I think they have the recent announcement with Uber and Nuro. I think that's going to help them, but are they going to be able to get some revenue streams from that? So that's another thing to watch, I think, with Lucid. But definitely, they need to be able to scale, be more efficient, and just have more mass appeal.
All right, Stephanie, got to leave it there. Stephanie Valdez, Streaty, Director of Industry Insights over at Cox Automotive. Both Lucid and Rivian shares moving lower in the after-hours trade. Rivian down about 4%. Lucid right now down about 6% in the after-hours trade. When we come back, we're going to break down more earnings. We're going to take a deeper dive into Toast, a deeper dive into Skyworks, a deeper dive into Snap. Also, we're going to have a conversation with Rich Weiss, friend of the program, over at American Century Investments. A lot more coming up here on The Close. Don't go anywhere. This is Bloomberg. All right, we promised you earnings, and we're giving you earnings. A roundup of the big movers in the after-hours trade. Jess Menton, Emily Grafeo, Isabel Lee standing by right now with a look at some of those names, and that includes the restaurant software company Toast. Jess.
So I'm specifically looking at Toast because this is a POS system in the cloud type space. And this is important because just earlier today, Toast actually announced a partnership with Amex to make kind of a better dining experience for customers. So with their earnings, if you're looking at this, originally Toast jumped as much as 7.8% in after hours. If you looked at their fiscal year 2025 adjusted EBITDA, it actually came in around 565 million to 585 million. Originally, it was around 540 to 560 million. So you did see that original pop there, giving back some of those gains, though. That stock, of course, is up 30% year to date through today's close. So it well outperformed some of its peers when you're looking at the transaction type stocks in the Russell 3000 index. So what's going to be important after the bell? Investors want to hear more about what this partnership entails, because remember, this is a company that got hit really hard during the pandemic, had to cut about half of its workforce. It had its IPO in September of 2021. It actually priced at around $40 a share. It closed today actually a little bit above $47. So investors are going to want to hear more about that. But we have some other stocks we're looking at. Emily, what are you looking at?
All right, Jess, I'm looking at Match Group, the parent company of dating apps Hinge and Tinder. We have a nice pop here. That stock up almost 10% in the post market after they did beat on their third quarter revenue forecast, and the prior quarter revenue also beat, coming in at $863.7 million. Direct revenue in both Hinge and Tinder really driving the strength here. The company is also pledging to invest $50 million in product development, in marketing, reflecting perhaps some pressure from some activist investors. Elliott Investment Management is one of those activists that's been pushing the company to bring out new products in Tinder. So perhaps we're seeing some signs of a turnaround here. Also, just again, a nice pop here for these earnings. This company had seen a years-long revenue slump, and it seems to be starting to climb out of that. Isabel, what are you looking at?
I'm also seeing green on the screen here, Emily. We're looking at Skyworks Solutions. The shares are up by almost 10%, up now by 9%. This is after the company reported fourth quarter earnings that beat estimates. So Skyworks Solution is a wireless chip maker and counts several megatech companies as its clients. So the guidance they put out was around $1 billion. That's compared to the $883 million they previously estimated. Skyworks forecast adjusted EPS that's higher than projected at around $1.40 versus 99 cents. And guess what? Their adjusted EPS came in higher, as did the revenue and their adjusting operating income. The company said it's encouraged by the momentum they see in mobile and really just encouraged by the overall strength in their broad markets. And also, they raised quarterly dividend to 71 cents per share, up from the 70 cents per share that they previously announced. Back to you, Romain.
All right, thanks there to Isabel, Jess, and Emily there. Skyworks, one of the biggest gainers in the after-hours trade. One of the biggest decliners is Snap, down 15% after the company reported revenue that missed estimates and provided a lukewarm third quarter outlook. Mandeep Singh joins us right now, the global head of technology research here at Bloomberg Intelligence. They mentioned something about issues with their ad platform. What was going on?
Well, clearly the ad revenue growth number was not up to the mark when you compare it to, Meta growing at 22% and Reddit had an exceptional quarter. So Snap's revenue growth was 4%. The overall top line was 11%, but that included Snapchat Plus subscriptions. Mm-hmm. And look, they talked about, how they are focusing more on direct response ads. Yeah. Changing the ad platform to accommodate more advertisers that are looking for that type of ads. But But overall, it's just bad execution, I would say, compared to the rest of the peers.
And they kind of admit that. I mean, the exact quote from their release is basically that in our efforts to improve advertising performance, we shipped a change that caused some campaigns to clear the auction at substantially reduced prices, which I think is just a fancy way of saying
and so
it.
ad pricing number was actually worse than the first quarter. So ad pricing fell 10%. And in an environment where we saw Meta's ad pricing grow 9%, that is a big contrast. And clearly, Meta operates at a much bigger scale. So from that perspective, I mean, clearly their costs are going up. It's not showing up in the advertiser engagement and pricing. And it's just a story where they'll have to execute better going forward. And the last thing I would call out is the video content. So they said Spotlight is 40% of time spent. Compare the monetization to Reels, which was a bright spot for Meta. So clearly that video ad monetization is much weaker for Snap than it was for Meta.
All right, Mandeep, I always learn something when you're here on set. Always appreciate you jumping on in these busy days. Mandeep Singh is our global head of technology research at Bloomberg Intelligence on a day where we get a fire hose of earnings that now kind of takes us into the last leg of the earnings season. And we've learned a lot. To get a broader picture of what we learned and maybe hopefully to get a broader picture of what might come next, let's bring Rich Weiss into the conversation, Senior Vice President and Chief Investment Officer for Multi-Asset Strategies at American Century Investments. And you're here in New York City. Normally you're out west. Great to have you back here in your hometown. I just want to point out expectations coming into this earnings season. We're pretty low. I think Bloomberg's own estimates, Bloomberg Intelligence's own internal estimates, was something like 2.8% growth in the S&P. As of right now, what the companies reported, we're closer to 10% earnings growth. Is that something to sort of embrace, or is that maybe an anomaly?
Oh, sure, and I think we have been embracing it these last few weeks, but I don't know that it's got legs. I mean, that's the issue. That's the macro picture, right? We came in low. We exceeded those fairly low expectations. I would imagine revisions or forward guidance is now going to come down, and I think it's going to be a lot tougher to be beating those estimates in the second half and certainly into 2026.
You know, 2 weeks ago, if you were on the show, I probably would have pushed back on that. And I would say, well, you know, you look at the earnings, everything's fine. Of course, since the last couple of weeks, we've gotten a couple of big data points, including that jobs report on Friday and that ISM services number today, not to mention the ISM manufacturing number, which was also awful on Friday, which seems to finally ratify a lot of people's fears about this tariff policy rollout, that there is an economic impact, and it is going to trickle in not just to the economy, but to corporate bottom lines.
No question. And I think our position, which you may remember, has been fairly conservative, diversified coming into the year, has been vindicated. The so-called hard economic data is now matching up or following the soft economic data, right? The expectational survey data has been forecasting a deceleration, if not downturn, for some time now. But now evidence in the hard data, right? The labor stats and the factory orders. The manufacturer data has been pretty poor for a while now. But now we're getting hard evidence of it. So the hard data is softening, and they're meeting down in the deceleration turf. I think last I saw, the consensus for U.S. real GDP growth was 1.4% for this year. I expect some of those will be ratcheted down. That puts us at, you know, kind of a dull normal year.
Wow. So what does that mean, though, for asset allocation? And let's start with just specifically with equities. You're underweight still, right?
Yeah, marginally, but overweight non-U.S. equities.
Oh, non-U.S. equities.
Yes, sir.
So you think there's a better growth story outside the U.S. in terms of equities?
Better valuation story for sure, and better growth story. I think they're a little bit ahead of us in this economic cycle. As you well know, over in Europe and elsewhere, they've been easing monetary policy for some time now. They don't necessarily have the inflation pressures we have. They're not as consumer-oriented. And even with the most recent tariff deals, Vietnam, EU, they are not placing tariffs on our exports to them. So their consumers will not be taxed as we will be.
So you're, I mean, not to make this political, but you kind of agree with Trump about maybe the fact that Powell might be a little bit late, as Trump would characterize it.
It's looking maybe now like that, but I wouldn't count out inflation as being more problematic than growth right now. I certainly wouldn't disagree with the president, but I also, I'm a supporter of Chairman Powell. He's been prudent. He's been waiting. Now that the data is starting to come in, clearly growth may be a problematic. But inflation is not off the table. Yeah. We have the one big beautiful bill. Most of the expenditures and tax cuts, which are going to add to the deficit, are front loaded. Yeah. Right? The savings don't come for the last few years. So I think we're going to have more inflationary pressure. It's still a question whether the Fed should lower interest rates now, even with growth decelerating, because, as always, they're stuck between a rock and a hard place.
And it gets to the idea, though, even if they cut, I mean, assuming they cut in the normal increments of 25 basis points, I mean, what does that actually do in the short term?
Yeah, and I don't know that they're going to get to the president's desired rate of 1 or 2%. I'm not sure where he was going, but I think most economists do acknowledge that the real rate of interest, or the natural rate of interest, is quite a bit below where we are. So at least 2 percentage points over time.
How do you feel, though, with regards to U.S. equities and the leadership we've seen amongst the big tech companies, which is largely because of all of the promise of AI and all the potential value it might unlock? Are you a buyer?
Of equities in general, at the margin, not so much. But certainly we believe in the longer term benefits of the AI boom, right, and how that's going to shake out. But this market, to your point, Romain, very concentrated still. You look at the broader indices, right? What is the S&P up? About 7% year to date? Yeah. The Bloomberg Aggregate Bond Index has basically done that without any of the volatility. Yeah. The Russell 2000 still underwater. Yeah. And by the way, another comment about what kind of market this has been, I would not characterize it as having been a bull market, even with the second quarter. The defensive utilities sector is the leading sector year to date, point to point. Yeah. What does that tell you? And gold, up 25%, give or take. Yeah. It's been a market to be cautious and prudent. That's where we started the year. We suffered through the second quarter with that rebound, but that's where we remain, and I think that's where we're going to be for the second half.
Where is opportunity right now in terms of, I mean, do you find anything attractive? I mean, across all the asset classes, is there some pocket that you look at and you say, okay, this is a good time, this is a good space?
Sure. Well, my wife's always a big fan of gold, but aside, for personal reasons, but aside from that, overseas equities, we definitely see some promise. In the fixed income area, it's hard to argue. You're getting 4% on treasuries, and then another percent maybe, or at best 2% as you ratchet up the credit. We just don't see anything.
We had Kevin Nicholson over at Riverfront said the same thing. He's a fixed income CIO, and he basically said, I'm paraphrasing, he basically said, I don't get out of bed for anything under 4%. It's just not worth it.
Right, and that's why utilities are doing so well. Why not grab a utility? We get some growth and a heavy dividend. It's a much safer play with more growth opportunity.
And on that point, we were looking at some of the factors the other day, and we were looking at the outperformance on a pure factor basis with dividend payers, and even on a long-short basis, dividends, and a lot of companies that fall, I guess, more into that value perspective. We're actually doing pretty well.
Yes. Momentum took over in the second quarter. And you know what else has been doing well? Because it's correlated with the value factors and some other size. ESG. Yeah. ESG and sustainability.
Is ESG still a thing? I thought we weren't allowed to say that word anymore.
I don't think it was canceled. It's got 3 letters, not 4. And ESG has come back this year. It's one of the better performing sectors or categories of the stock market.
All right. Well, you definitely gave me something to study later tonight, because I have not looked at the ESG space in a while. Rich, I have to leave it there. Rich Weiss is Senior Vice President and Chief Investment Officer of Multi-Asset Strategies over at American Century Investments. We continue our coverage here on The Close, a deeper dive into the earnings that just happened, and, of course, a push ahead to the earnings that coming tomorrow. Looking there on your screen, you see the after-hours trade, and it is a lot of red on the screen. Of course, AMD leading the charge down, and that could have the biggest impact on futures going forward. Supermicro also in that chip space, down about 15%. And Supermicro's results, of course, obviously a big player in the data center space, that's actually dragging Dell down. They did not report earnings, but you see they're falling in sympathy with Supermicro. Stick with us. This is The Close on Bloomberg. We're still talking earnings, and we're talking Disney. And a big questions right now about whether there's any magic left in the kingdom. The company reports 3Q results before the bell tomorrow, with the shares already up more than 25% in just the last 3 months alone. Analysts expecting strong spending on both the streaming and on the park side. Paul Verna joins us right now, Vice President of Content over at Emarketer, to talk about what is going to be the biggest earnings of the day tomorrow, at least in terms of the size of the company. And when we talk about Disney, I mean, obviously we can break this down in its various components, but I want to start with the overarching umbrella of what this company is supposed to be, the sort of, I guess, diversified entertainment model, if you will, Paul, and whether that still, in your view, is a viable model.
Well, I think Disney is making a pretty good argument that it is a viable model. They're on a good streak, as you noted. If you look at their stock performance year to date, they're tracking just right around the S&P 500, which is respectable, especially when you look at what had been happening with Disney over the past several years. So they're on a good run. They've had 4 straight positive quarters. They are definitely trying to refashion themselves as a streaming-first company and trying to make that model work. They're in a heated competition with the likes of Netflix and YouTube, but they're definitely in the mix. And I think they're more successfully navigating that transition away from legacy media into digital media than some of their peers.
It's kind of interesting, too. I mean, we talk about the catch-up that some of these streamers have been trying to do with regards to Netflix, 300 million subscribers. I think Disney Plus has something around 130 million, which I think maybe puts it maybe number 2 if my math is correct here. It gets to the idea as to why we haven't seen more of a catch-up, given just the depth of characters and brands and just, you know, iconic franchises that fall under the Disney umbrella.
Well, Netflix had an early mover advantage in streaming. Frankly, you know, Disney, I think they have been playing catch up. It's never fast enough, certainly not fast enough for investors that, you know, I mentioned the stock, it's actually trading at about 2019 levels. So historically, it's not great. And I think that Iger leaving and now returning definitely jeopardized that trajectory. They might have made a faster transition to where they are now or to where they're trying to be if that hadn't happened. So yes, they have some ground to recover. But again, I think they're in a pretty good place. It's hard to compare these companies. Yeah. Disney is inherently different. They have so much more. It's so much more of an entertainment empire, which, to your point, should put them in a position where they can leverage a lot of that IP and those brands, which they're doing. But on the other hand, I think their attention is more fragmented across parks, across movies, across traditional television, across streaming. Yeah. Whereas Netflix does the one thing they do, and they do it very, very well. They have a lot more focus.
They certainly have a lot more focus. And of course, I mean, I started off asking you kind of about that whether that sort of a broad model is still viable. And I do sort of wonder, in the context of some of the economic data that we've gotten, Paul, whether investors should start to be a little bit more worried. This is still a company that relies pretty heavily on its parks business, and for several quarters, it was the main driver of profitability. But if times are getting hard, and your wallet is getting a little tighter, the last thing I would think you're going to do is, pack up your family and spend 10 grand at Disney World.
Well, that's what everybody thought last quarter, and then the parks business actually delivered a very, very strong performance, which is also interesting because a year ago, Bob Iger had issued lower guidance for the parks business. He said they were going to have several rough quarters. So sometimes it's hard to predict, and it's hard to align the economic conditions and consumer sentiment with what actually happens in those parks. But I do expect that the parks business is going to hit some serious headwinds because of the factors you mentioned. And I think, frankly, entertainment choices are moving in different directions now. So I think there's a lot more at stake for companies that are trying to attract people to theme parks.
We're also talking about a company, given its current model, is sort of competing with companies that are kind of rethinking their own models, whether it's kind of the reimagining of Warner Brothers Discovery for like the umpteenth time, whatever the heck Paramount is going to look like when that gets fully integrated with Skydance. And I know ESPN is going to be spun off, so there is some ability for the company to kind of take some of its properties and move them out the way here. But do you think they'll lean a little bit more maybe into that idea of maybe splintering off some of these businesses?
It was looking that way about a year plus ago. I think Iger had said that all options were on the table, and it caused quite a lot of consternation about Disney spinning off its linear TV business pretty much immediately. That did not happen. He walked that back, and I think they have been a little bit more eager to hang on to those brands than Warner Bros. Discovery or Paramount. However, I think we are in a moment where you have to pay the piper, right? Like those businesses are just not going to recover. So it's more a question of how and when than if you're going to spin off some of those assets. It seems inevitable to me. It may not happen in the next 2 quarters, but it certainly will happen the next year and a half.
All right, Paul, I'll have to leave it there. Paul Verna is Vice President of Content at Emarketer as we await those Disney earnings, which will come before the bell tomorrow on Wednesday.